Good morning. How's everyone today? Excellent. First off, thank you very much for inviting me to this prestigious event. I'm going to walk through some of the key ideas and trends that we in UOB are observing today or paying attention to. Very quickly, these are some of the things that I'll be walking you through today. First, I'm going to start with a very, very short video. Don't worry, it's not a UOB advertisement, but it's a video to test your observation. I'm also going to go through some of the key ideas or questions that my investors are asking me today. Things like, what's happening in the interest rate world? What about the trade war? And definitely about Singapore. Recession is also on everybody's mind today. Everyone is making their bets or their assumptions that recession is going to happen in the next 3 months, 6 months, a year. We don't think so, and I will evidence why. Last but not least, we have a different way of thinking about portfolio allocation, and we want you to rethink how this portfolio allocation will impact your long-term strategy. Now let's very quickly watch this video. In this video, you will see a number of children dressed in different colors skipping ropes. Now what I want you to do is focus on the girls in green and count the number of times they skip the rope, collectively and individually. All right? So just count the number of times they have skipped the rope. Ready?
Ready? Go.
So how did we do? Show of hands. Who counted 35? 40? 42? Well, actually the right answer is 38. But that's not the real question I wanted to ask you. How many of you saw a giant chicken dancing? Okay, a number of you. Very good. For those who miss or don't believe there's a giant chicken in the video, let me show that to you again. See, this is a social test that we have run many times, and the majority of our audience have missed the dancing chicken. Why? Because it's a human phenomenon. We tend to miss sometimes what's directly in front of us, often focusing on some of the big noises that often bombards us on a daily basis. This is called selective attention. What I'm trying to say today is that there's trade war around the world, technically. Interest rates are rising. The yield curve is flattening. Italy has a new government. They don't like the euro. But all this, big news, they hit us very often. But sometimes we also forget some of the key fundamentals behind the market that's truly driving those markets. The world is evolving. It's evolving to a new normal, or to us, a real normal. This is a real normal, where labor conditions are tight. In fact, in the United States, at 3.8%, the US is enjoying a near 5-decade low since 1969 in unemployment. Spectacular considering it was 10% in 2009. This is also an environment where wage growth exists. Well, nominal wage growth has been creeping up in recent months, but real wage growth, unfortunately, has been pretty benign and eroded because of inflation. But regardless, as consumer has more money in their pocket, their sentiments are better, they're more positive about themselves, their future, they're likely to consume, buy more, eat better, travel, make big-ticket items. But typically when this happens, when this goes on too long and too much demand exists, when it outstrips aggregate production, inflation exists. Now, inflation is not a bad thing. Don't get me wrong. Inflation is actually good because it means that the assets in the future is worth more. But too much inflation is bad. And that's pretty much what the central banks around the world try to manage. And we see the United States Federal Reserve starting their tightening policies. Why? Because interest rates rein in this excess, this exuberance in the market. And as a result of which, you often see central banks hiking rates as one of the many tools available to contain inflation because they don't want an asset bubble. By taking the liquidity of this market and rising the cost of operating in a business for businesses and companies, you're likely to see increased volatility. And this is what we saw in the earlier months of this year. And we expect this to continue into the second half and probably into 2019. Now, it's really not all bad news, because there are some real drivers which are technically in front of you, but we may have forgotten them. Corporate earnings are at an all-time high. 78.2% of S&P 500 companies beat estimates in the first quarter this year. The long-term average for this is 64%. They came in at 78%, suggesting that the economy is in very, very good shape. Companies are very profitable. Earnings continue to expand. With a tight labor market, clearly, you need increased productivity. And we see that both on corporate and on the international level, especially in some European countries. These countries have become tremendous exponent of how productivity can actually be turned around. Clearly, when shareholders, business owners see this recovery, they're more likely to open up their purse strings because they get very good returns on their investment. They see good use of their capital. They're likely to invest more in a company. 2017 saw the highest increase in terms of non-residential asset investments. This took a very, very long time for it to pick up, and we are now finally seeing evidence that companies are starting to reinvest a lot into their own companies. And this clearly brings about economic growth. Today, PMI, Purchasers Managers Index, an index for us to see whether a country is expanding or not, pretty much punched above 50, suggesting that most countries are still in expansionary mode. The current global aggregate is about 54. So we are growing, not shrinking. Mr. Trump, of course, with his recent rhetorics and threat to have a trade war with practically everybody in the world, has kind of put the spanners into global trade activities. But internally, our base case is that calm minds will prevail and that we won't go into a full-fledged trade war. But that leads very much to be seen. Last but not least, this real normal is also propelled by technological advances, disruption, and innovation. We know that the very fact that our life today, how we consume, how we spend, how we entertain ourselves, that's going to change. And we have seen that in many spaces in the world. It's not just confined in the technological space. You see it in consumption, you see it in gaming, you see it in how you make your payments. So there's a lot of changes that's propelling this global growth. Some of the key questions that I get internally in the bank is clearly rising interest rates. And I'm sure most of you are concerned because it will have direct impact on you, your portfolio, your assets. We use an investment clock. In this clock, it tells you, well, basically the top half of this clock is about the boom period and the bottom half is about the bust period. So clearly on the top right-hand side, either economies will slow down, moving on to a recession, moving to a recovery, and then a boom cycle. These are the natural cycles of the equity or the global markets. Today, we believe we are in the boom cycle. Some even say that it's in the late boom cycle. This clock tells you where we are, but it doesn't tell you how long we'll be in that cycle. There are many indicators that suggest that perhaps we are in a more mature market. For example, the Fed has been normalizing the rates 7 times since 2015, I believe, and we expect more to come this year and next. We have also identified some of the key risks that inflation or inflation overshooting might cause central banks around the world to tighten too quickly, too fast, resulting in a 1930-like double-dip recession. Assets in this cycle, like properties and commodities, we think will continue to be very well supported. In the US, and this at the time of writing, unfortunately, the PCE, or the Personal Consumption Expenditure Index, was below 2, but as of last week, it has already cracked 2. So all the key indicators in the United States are already above 2. We believe that 2 more rate hikes is warranted this year to ensure that inflation doesn't run away. The strong US dollar interest rates, it has hurt emerging markets. It has hurt us. The reason is this. Since 2009 and 2013, over $4.5 trillion had flowed into these emerging markets. A lot of this money found its way into fiscal policies, into repaying debts. But we believe that with rising rates and the stronger dollar, that flow is going to reverse, which bodes badly for emerging markets. And that's the reason why we saw emerging markets taking a huge beating throughout the course of this year. This results in higher borrowing costs, higher refinancing costs, and harder to service some of their debt repayments. Especially countries with the twin deficits, current account and fiscal deficits. These countries, we feel, are the ones that will be most impacted by the strengthening dollar and the rising rates. And of course, when the positive carry in emerging market debts disappears, funds are going to flow out to the more attractive treasuries. So what about this impact on stocks? Most of us invest in stocks, or maybe unit trusts. Share price is a reflection of future earnings of a said company. When margins get tighter, thanks to the costs brought about by interest rates, you're going to see a yield compression, earnings compression. And when that happens, clearly share prices cannot continue to rise. It's got to reflect the less profitability of that company going forward, and as a result, you're going to see share prices falling. But there are some exceptions. Throughout the course of the financial crisis, many companies have been sitting on cash, namely the technological companies. Now, these companies will be less affected because there's a need for them to go out to the markets, the capital markets, to borrow money. We also believe that banks and financial institutions will do well in the rising rate environment. Number one, because the global economy is better, so our asset condition is a lot better. We are more positive about it. And at the same time, our net interest margin, jaw, will increase. Why? Because we can borrow at a lower cost and charge you guys at a higher price. So don't quote me on that one. Historically, we've also found that the US Treasury needs to be at 5% before corporate performance is negatively impacted. If I'm not wrong today, the 10-year stands at 2.86, thereabouts, or at least the last time I checked. And we think that it will max out at 3.8, at least for the near term in 2019. So we're still pretty far away from interest rate hitting the 5% mark. So I don't think at this current juncture we should be overly concerned about the performance and growth of companies. Bonds, my colleague will cover a lot of that later. But as a broad general asset class, bonds are negatively affected by rising rates because they are inversely related. Of course, riskier bonds, the high yields, will find it very, very hard to borrow money unless they are more willing to pay excessive premiums to get those money into their coffers. In the bank, of course, there are certain exceptions. We like short durations because short durations has a negative or less sensitive correlationship to rising rates. We also like floating rates, clearly because interest rates are rising. Floating rates will definitely benefit your portfolio, and we definitely like covered bonds. Properties, something which is very close to practically every Singaporean's heart. The cost of borrowing is going up. We've got to accept that. I have a chart of that later, and I'll show you how and why it's going up. And for people who have investment properties, your rental needs to keep up. But unfortunately, that is not reflecting in our current system. Rental is not keeping up with the cost of borrowing today. Commodities. There's a cost to holding commodities. Typically, when you buy commodities, you have to pay for holding it. And that is net negative for the asset class as well. But in the longer term, we feel that if inflation is a big threat, gold and oil may benefit. And countries, possibly like China, will start hoarding a lot of commodities, base metal, so on and so forth, for future expansion. And that is net positive or supportive for commodity assets. I spoke about volatility just now. Volatility has indeed spiked. The average long-term volatility percentage is 19.3. Today we are all right. Today we are about 12.8. So we are really not in the risky zone. But let's just have a very quick look on what it looked like earlier part of this year. In February, fast trading, high-speed trading was accused of spiking volatility because of the optionality that traders had to pay. And we saw a huge spike then. Towards the end of March, tech stock took a beating. Why? Tech stock had a brilliant year in 2017. But in 2018, Facebook was charged, and many investors out there were concerned that the advertising dollar in Facebook will plummet. Instead, Facebook advertising dollar went up 43% in that same period. Of course, we had the Italian election, the rise of populism again, but then went away very quickly, and most recently, emerging market sell-off, thanks to the strength of the dollar. But we still think that central banks around the world continue to be very accommodative. The ECB will continue the asset purchasing program until the end of this year, and possibly, very possibly, rise their rates in the middle of 2019. Japan will continue to be very accommodative. Now, what about trade war? Many people talk about the US-China trade war. In reality, it's Trump versus the world trade war. The United States started this ball rolling on the 22nd of January, threatening to slap tariffs on washing machines and solar panels. That, of course, escalated, but the Chinese has been pretty benign in how they dealt with the Trump administration. They have been, how would I say, not aggressors. In many ways, this actually prompted Trump to go out there to say trade wars are easy to win. He went to further push that number to a 50 billion and slapped the first 34 billion in July and the next 16 billion 2 weeks after. Now he threatens the rest of the world, his former allies, Canada, Mexico, the EU. And this retaliation to the United States may see a very big loser in the United States stance. Trump then further announced another 200 billion that he's going to slap on Chinese imports. And the current public comment is ongoing right now. This is the main reason why. China exports 2 trillion a year, over a quarter of which goes to the United States. In exchange, they import about 130 billion from the United States, which leaves them a huge gap of 370 billion on an annualized basis. So Mr. Trump wants to go out there and address that because as part of his campaigning, it is to make America great again. But what we don't know is out of the 500 billion out there, how much is truly China's value add to this 500 billion? Or are there other casualties on the side that will be impacted by these tariffs? And I will show you an image later which might make it a lot clearer to you. But in the near term, we think that export-reliant companies or economies will suffer badly. Why? Because as global trade slows down, export-reliant economies will naturally suffer. We estimate that the impact on the Chinese and the US economy is not that great. It's only a negative 0.1 or 0.3%, which is kind of small if you ask me. Chinese is a 12 trillion economy. The United States is a 20 trillion economy. So a 20 billion slap on the wrist to China, it's not going to derail China in a very big way. We still think that they're going to continue to grow at a 6.7, 6.8% on an annualized basis. The longer term impact, of course, is that companies may relocate. We already saw Harley-Davidson speaking out that they want to move their European production to Europe to avoid European tariffs against US exports. So this is real. And China's just not going to sit around. China has not been sitting around. China has been extending their influence and their investments on a global scale, reaching out to Africa, the Middle East, Asia for sure, and the EU, making new friends. So they are not totally reliant on the United States. While some may say, well, hang on, Abel, US is the biggest customer to China. If they are going to pull the plug, what's going to happen to China? Don't be overly concerned because China has changed their model in the last 3 years. They are no longer manufacturing and export-driven or highly dependent on that. They're a lot more focused internally, so they're more internal domestic markets, and they're a lot more supported in that sense. This is Apple. Many of us own an Apple. People think that Apple is made in China. Well, yes and no. China only adds about 346 parts to the Apple iPhone, the rest of which is actually spread around the world. And these are the economies that are the most vulnerable because if you are feeding into the value-add system to make our final iPhone product, and if Apple phones goes up by 20% around the world, your demand is going to fall by a tremendous amount. So economies, not just China, will be suffering. Singapore. We think Singapore will moderate in the second half or throughout the course of this year. We think that we are probably looking at about 2.8% GDP, coming off a very strong 3.6 in 2017. Inflation very well contained at 0.6%. So I think that Singapore may be heading into a slightly dimmer second half. This chart shows you how reliant we are on global trades. And when global trade starts to slow down, Singapore being one of the most open economy in the world is likely to feel some of that impact. Singapore, of our exports, total exports, Singapore 61.6%. Sorry, the number is a bit small for me even. It's about Singapore value adding to end products, which means that we are very vulnerable to a global trade slowdown. To give you a sense of the things, Luxembourg is about 75%, which means the bulk of their produce is about value adding. So we are in a slightly difficult situation. Dollar Sing, most of us trade currencies, or at least have some form of investments, or even shop. So if you want to buy something right now, you might want to consider doing it soon. We think that the 130 level is a key support for Dollar Sing. We are already nearing the end of towards the end of the 130 level mark. Currently, $1 Sing is about 137. We feel that the Dollar Sing will be reaching about 139. We just revised it yesterday, so at the point of writing, this is slightly off. And the target for Dollar Sing will hit 141 middle of 2019. So if you're looking to buy US dollar assets, now is a good time to get in. LIBOR is increasing. Traditionally, LIBOR has been an indicator of bank stress or bank risk because technically it's how bank lends to each other on an international scale. But this time now it's different. We don't think it's because of financial stress. We think it's because of the withdrawal of liquidity in the market and the spike in the 2-year treasuries. So we think that the LIBOR is spiking up because of these reasons. And if you look at the charts right there, you will also see that our SIBOR, 3-month SIBOR and 3-month SOR tracks pretty closely to LIBOR, which means in the nearer term, you are likely to see both 3 months LIBOR and SIBOR and SOR to cross the 2% mark in the middle of 2019. So for property owners, pay attention to this. If you have not refinanced your property, think about it soon. Singapore's non-oil domestic exports. We did well in May, mind you, at 15.5%. The only component that did not do so well was electronics, coming in at negative 7.9. But in the month of June, global impacts, global slowdown started to show itself. We only grew 1.1% in the month of June, year on year, a far cry from the original 15.5% in May. So this is a little bit worrying. We are encouraged, however, that the non-electronic exports continue to do well, especially in the pharmaceutical space. But it is the electronic space that we are concerned about, because this is the 7th month that we have had a negative. And this includes integrated component, integrated circuits, PC parts, consumer electronics. So we are concerned about this trend. So we feel that this weakness is likely to extend into the second half of 2018, namely because we had such a high base. 2017 was a spectacular year for Singapore, if you remember, at 3.6% GDP growth. We think also that the trade war will definitely have a negative impact on Singapore and on the Singaporean economy. So we are concerned about this. And because you saw in the earlier chart, Singapore is highly dependent on global trades. We know that if a global slowdown really exists or comes to our doorstep, we will be negatively impacted. So these are some of the things that we are looking at today. We expect Nordex to moderate at 6.5%, down from 8.8% last year. Recession. Everyone is talking about recession these days. Some people are predicting that recession will happen in next year, 2019. We don't think so. We study a number of charts, and let me just, I won't go through all of them, but I'll share with you some of the things that we look at today. The first one, the 210 yield curve. Yes, it's been a very good predictor of recessions. The last 3 recessions, the yield curve inverted and the market went into recession. But what people don't know is that it takes about 17 months on average after the yield curve inverts before a recession actually takes place. Internally, we think that the yield curve will invert probably middle or later part of 2019. So we're still very, very far away from inversion and an actual recession hitting our economies. The next thing that we look at is the Conference Board leading indicator. This measures consumer confidence, wage growth, core inflation, amongst other things. This indicator is also a very good predictor of recession. In the past 5 earlier recessions, it spent 1 year in decline before the recession took place. We're not seeing it today. Instead, we're seeing it improving. In other words, wage growth are coming in, inflation is benign, consumer sentiments are still very, very high, amongst other things. So we are not overly concerned in this space. What else are we looking at? The spread between high yield and investment grade. Clearly, in times of distress, high yield bonds need to pay a lot more to get people to buy their bonds. And when that widens tremendously, like 2009 and 2001, you see the spread widening tremendously. Today, not much evidence of that widening either. Again, not overly concerned. So many people come to me and ask, Abel, what did it look like in 2007? 2008 was one of the worst financial crises we ever faced, agree? What did it look like in 2007? So I pulled out those data just to show you where we are. In 2007, practically every single indicator was in the red zone, i.e. dangerous and recession is imminent. Today, almost everything is on the green zone, that inflation is not imminent. And most of the indicators doesn't suggest that it's going to happen tomorrow. So there's a lot of pessimism in the markets today. I think it's a great time for you to pick up certain ideas, great entry points, for you to invest in some of the ideas that you have been monitoring. Last but not least, we want you to rethink how portfolio is allocated today. Most of us will retire. Most of us will need money when you retire. I mean, this is Singapore after all. But most of us may not have enough money to retire. 82% of Singaporeans don't have enough money to retire comfortably. We have done the statistical test in Singapore. Why? Because the world is evolving a lot quickly. Prices are moving a lot faster. Maybe our wage growth may not have caught up. And we may not have started early enough to plan for our future. Traditional portfolio talks about having a core portfolio of global bonds and global equities, and at the same time slapping tactical ideas, sexy ideas into this portfolio to form your tactical ideas portfolio. But this doesn't speak to a retiree. It doesn't speak about needing money. So we wanted to rethink how portfolio should look like. A portfolio to us should have a solid foundation. You need to safeguard your assets first. And then you talk about building income. And then you talk about taking part in market opportunities. Let me just briefly go through some of this with you. We believe that safeguarding your asset is very important. And in fact, it's impossible if you don't have this and build a portfolio. Far too often, we have found investors taking on too much risk or too little risk. Too much risk to achieve their end goal, and as a result, getting burned. And we heard this many times. Oh, I invested too much into XYZ fund, too much into XYZ stock, and it went belly up, and I'm burned. But at the same time, people want to retire comfortably, but they take on too little risk. Oh, no, I don't want to take on risk. Fixed deposit, that's it. But you can't achieve your long-term goals if you just hold fixed deposit and not take risk. So we have rethought about this entire portfolio, and we've come up with this. Number one, you need to have your solid base, safeguard your assets. That is protection for your loved ones, namely yourself and your family, and your estates. You don't want to pass on and leave a huge burden to your family. And of course, medical liabilities. This is very important. Medical expenses is high today, and it will only get higher in the future. We'll definitely need to make sure that your medical liabilities, the last thing you want when you plan for your retirement is to have a huge medical bill to offset or to clean out your entire savings. That's not what you want. So in this front, and I'm speaking in a very generic sense, you will want to consider hospitalization, critical illness coverage, whole life, and legacy plan. And of course, have that cash for the rainy days. Once you have got that sorted out and you know that you are safely covered, you want to build income. Your core portfolio of global bonds and global equities does not give you income. Well, some does, if you're investing in a dividend fund. But we think that there's a better way to do this. We feel that this portfolio, because as you retire, you don't want huge surprises and nights that you can't sleep. You want something that is low in volatility, something that can generate income from various sources, not just a single source. You also want to have a portfolio that reduces your downside. And why is this important? Markets are volatile. Markets will swing. There will be corrections. But the less you lose in a downside market, the faster you are able to recover in the near future and be able to accelerate that return. And that's important for someone who's planning for your long-term retirement needs. Solutions include endowment plans, global multi-asset solutions, and of course, bonds. And my astute colleague will cover that later. Last but not least, when you have already taken care of your income portion of your portfolio, that's when you look at market opportunities. Unfortunately, today, a lot of Singaporeans have it the other way around. The pyramid is upside down. Everyone's investing into high-risk investments, buying single stocks, taking punts in single sector investments. This should be the last part of your total portfolio because this is your high-risk, high-concentrated solutions. And these are the ones that can accelerate your returns and your capital growth, and these are also the ones that can make you lose a lot of money. So you need to be careful on how you look at it and plan out your portfolio. These are the ones that drive capital growth. But at the same time, it can also drive capital loss. It will have significant market fluctuation, and hence, this should be the last part of your triangle. In this solution front, of course, we can talk about equity funds, single sectors, global, single countries. And these are the ones that can make or break your overall portfolio. But if you have had already established a very solid foundation for your portfolio, these are the ones that can accelerate your long-term returns. I'm not going to go through the rest of them, but of course, based on your risk appetite, certain perpetuals, CoCos, AT1s, and structured notes may be suited to help you express your impression of the market. And hence, in UOB, this is how we look at portfolio management, how you asset allocate. It's imperative that you safeguard the assets, build that solid foundation. Then moving on to building an income stream for yourself, a meaningful income stream. And last but not least, capture market opportunities. Speak to your financial advisors. Identify which are the funds or the solutions that are most suited for you before attempting, and learn about the markets, because that's the only way you can actually establish a long-term, sustainable, and a solid foundation for your long-term portfolio. With that, I thank you for your kind attention. Thank you very much.